So let's talk a little bit about what's happening in the market right now and how you guys are navigating it. A tremendous amount of experience. You've been at it for a decade. You've bought a lot of real estate, and you've seen at least, you went through the pandemic, you navigated that with a significant portfolio. Now we have sort of a debt situation on our hands. Maybe give us your just high level thoughts about what's happening in the market today and what you and your partners are planning on moving forward into the latter half of this year, the third and fourth quarter of this year. So, just for context, we're recording this just the end of August 2022.
Yeah, so I mean, I was a banker during the great financial crisis, right? So 2008, 2009. I was kind of the grim reaper. So I started my banking career kind of early mid 2000s, and that the first part of my banking career, you couldn't make a bad loan. Everything's kind of went up, and then one day that all changed quickly, and then that was a pretty deep, severe recession. The banks kind of froze. I was working at a bank, so you go from being pretty liked, respected profession to kind of being evil overnight. Somehow it's kind of know what we did, but what I did at least. And then had about 18 months of just doing problem loan workout, trying to collect a bunch of money. My bank would have failed for sure, but we got bought by Wells Fargo. It was with like a regional bank. We got bought by Wells Fargo in '08. And then kind of coming out of that, started buying investment real estate in 2011 and started doing apartments in 2013.
Mm.
And so the entire time up into 2020, it was just nothing but the wind at my back. It's been great environment. So then 2020 was a little challenging, but it really had a lot of fear and anxiety going into March collections of 2020 when everything's kind of shut down. But reality turned out it really wasn't that impactful with all the money they printed. And then that's all the way up until about February of 2022 this year. And everything was kind of going gangbusters, and you start getting into March and April, and then and things started kind of really starting in April with the Fed hikes. And then you started what was a very robust and diverse roster of lenders that was available as we started 2022. Quickly, a lot of those guys kind of put pencils down, and the amount of liquidity in the debt market, and then the amount of liquidity that was chasing it from an equity standpoint certainly dried up starting in April. And June, July were pretty tough months. There's not a lot of transactional volume. And then now here we are kind of coming out of the summer. We're starting to see that kind of open up a little bit. August was much more liquidity, and kind of into July going into August. We found that the Fannie and Freddie model is working. There's some combination of them getting a little bit more aggressive, trying to provide a backstop and liquidity, which is unique to the multifamily industry. You don't have that in retail or office or industrial. It's only for multifamily. And then some of the pricing, kind of coming in a little bit, and then as well as the operations from occupancy and rental rates are still very strong. So some combination of all that is seeing and the agencies kind of come back to play. It feels like we're kind of in the space I play, which is more your class A, kind of the A minus, starting to see kind of some floors get set where I think price adjustments have happened from the peak, probably 10 to 15%, and starting to see some floors in Dallas and Austin. I think we're seeing some signs of that in San Antonio as well. And then, I think workforce housing, I think, we've been kind of lumping together B and C class deals. And I think we're starting to see, tiers of the risk start coming back into the pricing of these things, where, when I started in Dallas in 2013, you could buy a brand new class A deal for like a 5 cap. A B deal was like 6 to 6.5, and a C deal was like 8 to 8.5. And fast forward to the start of this year, everything was essentially a 4 cap or lower. There was very little of spread between the top of the grade and the bottom of the grade. You're probably talking 50 to 75 basis points in cap rate spread, which historically has been more like 300 or 350 basis points. So as we're seeing choppiness in the market, I think we're seeing the cap rates expand, generally speaking, but they're expanding at a much slower rate on the class A and a much larger rate on the class C. So I think there's going to be some tiers priced back in, where C class 60s and 70s deals in the Sun Belt are going to price at a higher cap rate than the 80s deals, which are then priced at a higher cap rate than the kind of newer stuff. So it's still kind of playing out. It's not fully settled and established, but that's kind of what we're seeing. So I think there's still probably a little bit of room to go on the lower end of the grade, and I think we're catching bids on the upper end of the property grade. That's kind of what I'm seeing in Texas, and I think that's probably generally the Sun Belt as well.